All right, we are recording. Cool. Welcome, everybody. Anna and I have hosted this meeting now for 3 years and 1 month going. Anna, would you please mute that person for me?
Hey, Justin, can you unmute yourself? I muted everyone.
Perfect. Okay, we'll start that one again. Anna and I have been running this meeting for 3 years and 1 month as of this meeting. So originally, Anna and I started this meeting in this meetup at Stanford University campus. No affiliation to Stanford other than it was a awesome place for us to meet up. Beautiful campus, central location for Bay Area people. And essentially, when COVID hit, we took it online. And shortly, a few months before then, Anna actually moved to Colorado, out of the Bay. So this has been really a beautiful way for us to continue to have the meeting, is to take it virtual and then open it up to really anyone in the world. And we've had people from across the nation, across the world join our meetings. And what's been even more awesome about doing this meeting virtually is the opportunity to have guests like Adam. So we've had everyone from Brad Barrett from Choose FI to Emily and James from Rethink the Rat Race. Most recently, we had Purple from A Purple Life. So usually every other meeting or so, we like to have a guest speaker. So we couldn't be happier and more grateful to have Adam from Minify.com. He's a FI blogger. He's been FI for a while. Through the relationship that Anna has, he was invited, and after a long wait, patiently, we got him for Christmas. So I'm going to throw it over to Anna real quick to say any additional stuff. But kind of general outline for this meeting is we're going to essentially, Anna and I will interview Adam, kind of get his origin story, because some of you may be familiar with him, some of you may not. And then we'll kind of ask, kind of all those questions. And then once we kind of cover his origin story, we'll start taking questions from both the Facebook group and from the chat. So if you're in the Facebook group, Anna, if you could drop the link, you can post your questions there. People can upvote the questions they really like there. And then we will actually take the most upvoted questions first. And then once we run from most voted to least voted, then we'll open it up to kind of whatever's in the chat here. So just kind of crowdsourcing to make sure that we're covering the topics that everyone wants to hear. But yeah, Anna, any additional things that I'm missing? Oh, for everyone, this is my fiance, my FI partner. Her name is Carly. She goes, her nickname's the Phoenix, because my nickname's the Dragon. So more about that at another time. But yeah, Anna, over to you.
Yeah, thanks everyone for joining. I'm so excited for having such a packed meetup. And I really want to thank Adam for spending precious time with us to talk about his FI journey. I met Adam last year at FinCon, and he by far was one of my favorite FinCon friends. So generous with his time, advice, super wicked smart. Adam, you might remember, like, one of our first conversations was you telling me about how you took WordPress and kept the database and then built an entire, like, Rubies on Rails, I think it was, website on top of that from scratch. And you can really tell, because Minify is a fantastic resource for investors of all stages. And he's really spent a lot of time and energy handcrafting this for a really great user experience. And so I've been addictively reading the website, because I also think Adam brings a new perspective about FIRE and an FI strategy that not a lot of bloggers talk about. And that's, what do you do if you have a high income earning potential and you want to go with the windfall strategy? And we'll talk more with Adam about what that means. And so there's been a lot of, great content. Adam can tell us more about the investor course that he created. A lot of the retirement calculators will cover all of that stuff. But I really wanted to bring him on because I think, Adam, you'll have a great ability to tell us about your experience pursuing FI, retiring early, using that high income strategy, which is not something we hear a lot about because there's a lot more, in my opinion, about frugality and saving and not always as much about how do we really supercharge our earning. So let's dive into it. Thank you so much again, Adam, for treating us with your time today.
Wow, yeah, thanks for that that intro, and Justin, that was amazing. And yeah, thanks everyone for joining. I think like any meetups I've been to here in Salt Lake have usually been like 20 people. So we're already like basically double that by having it online, which is really nice.
Awesome. Well, thanks again for joining. So tell us, Adam, your origin story, your FI origin story. I'd really love to know, I think we'd all love to know, like when and how you first heard about it, to kind of like start, and then, when did you start to take it seriously? And I'm going to pause there and just let you start, and then we'll continue to kind of like dive into the development of your, path to FI.
Sounds good. And if you see my door opening in the background, it's because my dog can't decide whether it wants to hang out with me or my wife. So it's like pawing at the door to go back and forth. So yeah, from origin story and financial independence and investing for me, I think like a lot of people, I didn't really learn anything about investing or FI in high school or college, even though I took like economics classes when I was temporarily a business major. Like there was nothing in there about like building personal wealth with investing. But about 3 months after I graduated, my mom passed away. And that left me with the house I grew up in and $100,000 that she had inherited when her mom passed away. It was a very, very tricky and hard time for me. But out of all of that, I kind of suddenly had this windfall and I had no experience on what to do with it. So I think like a lot of people, I just kind of went to my bank and said like, hey, what do I do with this money? And they're like, well, we'll set you up with an advisor and we'll start investing it for you. And so I kind of just went with the flow and just, did what they recommended, which was putting it in these high fee funds that had front loads. And front loads are effectively a fee that you pay just for the privilege of investing in it. And on top of that, there's usually a high fee. So I was like very, very indoctrinated into kind of the negative practices of the financial industry right away. And within like a year or two of that, I started really looking into like, hey, what are these things that they are investing this money in? And what can I do about it? And that led me to start learning about the boggleheads.
Context for where you're growing up and time. How many years ago was this?
Yeah, good question. So this is back in 2005 in Florida, Orlando, and St. Petersburg.
Awesome. Keep going. I just want all of us to have context because I'm like, this is cool, but like, when the heck did it happen and where is this happening?
Yeah, it would be very different if it was New York or rural America for sure. Orlando is kind of middle of the road in terms of income. Like you can still buy a house for like $200,000, at least at that time. And so through all that, I started learning about the boggleheads approach to investing, which is pretty much the same as like the FIRE approach to investing. It's a diversified, low fee, tax optimized index fund investing. It's kind of getting the basics right and then just throwing more money into it and letting it grow over time rather than like individual stock picking or something like that. And so for a couple of years, I was just doing that. And then I think when Mr. Money Mustache posted his shockingly simple math behind FIRE article in 2012 or so, that's when it connected like, okay, all this money I'm trying to invest, And now I have like kind of a goalpost on where I need to get to. So that kind of linked together these two concepts I was already thinking about. And since then, I was working at some larger companies and a couple startups. And I think we'll get more into this.
Florida?
Yeah, still in Florida,
Okay.
all in Orlando. I was working at, I joined a company called Code School as an early employee. It actually goes back to a meetup. Like all the employees at Code School were a part of the Orlando Ruby user group meetup. Basically every single employee was from that meetup. So the meetup basically became a company, and I kind of joined that company when it started. And that company ended up being acquired by a company called Pluralsight, and that gave me a nice windfall. And then the company that acquired us, Pluralsight, ended up going public, which gave a second unexpected nice windfall. And that led me to retire at age 36.
Wow, that's awesome. So just to kind of play this out for myself and the audience, essentially there was kind of like 7 years from 2005 to 2012 where you're kind of like, high fees, someone else is managing your money. You're like kind of like trying to do the best you can, but kind of just floundering around. And then Mr. Money Mustache's kind of shockingly simple math article kind of like was a light bulb to like, hey, maybe there's a better way, and maybe there's more of I don't know, some nuance or more strategic way to go about this. Is that kind of correct?
Yeah, with the boggleheads part in between, I kind of got weaned off of the financial advisor maybe in 2009. I think I started looking at it when my portfolio dropped 50% during the 2008 recession. I was like, wait a second, I'm just trusting this guy and I just lost half my money. Like, did they do something wrong? Am I doing something wrong? And actually at that time, it was just like everyone would have lost money. So
Yeah.
I wasn't alone there, but it did give me pause to look into what was happening and why.
Yeah. It's funny how it's, I think, it's a common theme as you read, about five people and listen to five people's journey. It's like when like money things like really take a turn for the worse, that we're like, hey, wait a minute, maybe I need to be paying way more attention to my money. So it's really awesome mention of the Bogleheads, as well as Mr. Money Mustache. So essentially, let's talk a little bit more about those two windfalls. Like, what'd you do with money? And then let's also kind of talk about like, how did you start to like plan to like, fully pull the trigger on FI?
Yeah. So from like a starting point standpoint, I really was extremely fortunate there. Like I went to a state school, UCF, on like a 75% scholarship, which meant that my tuition every year was $500. And nowadays I like look at it and I'm like, I can't believe how much college costs. Like the starting point is very different. So I'll preface everything I'm about to say with I started from a very good place. And so when I got that windfall, as I said, wait, let me back up. What was the next question you said about?
So essentially, let's talk about the windfalls. Is the first part of the question, and I apologize about like multi-tiered questions. The second part is kind of like when and how did you start to plan for pulling the trigger on FI? Just so we have an understanding of like, hey, what'd you do with that money? And then when did you really start thinking about kind of like really pulling the trigger on FI?
Right. Yeah. So one of the things that was interesting was like that first windfall, in this case, the inheritance when my mom passed away, that went straight into financial advisor. But what was nice was that by learning about the Bogleheads approach and Bogleheads, I always say Bogleheads, but it is Bogleheads. The Bogleheads approach, when Code School was acquired and I got a windfall from that, instead of going to an advisor, I was able to say, okay, let's let's put this straight in my Vanguard account. Let's allocate it between, I think it was VTSAX and VTIAX, which is like the total US stock market and the total international stock market. And one thing about both of these windfalls that I think is worth talking about is that since they were both in brokerage accounts, they're both being invested in after tax, or just regular taxable accounts, which is very different than investing in like a 401k or a Roth. So every one of these accounts, any sales I have of those funds, any dividends, any rebalancing is going to be a taxable event. So I think because of that, you kind of have to know a little bit more ahead of time about what you want to do, because making changes later on is going to cost you a lot more money than if you were to rebalance your 401k, for example.
That's really interesting. So I'm actually curious, kind of on that note, during your time at these companies, did you actually put any money into your 401k, or was everything, or were you doing both? Like, what were you doing there in terms of the windfall, as well as like, company 401k? And I don't know if you had match or anything like that.
Yeah, one of the kind of, in retrospect, somewhat crazy parts about working at a startup is that, in my case, the benefits were very different than at a large company. So when Code School started, there was no 401k, there was no health insurance, and we had to pay to park in the building that we worked at. So like, we were getting equity in exchange for it all, but, we had to kind of make up the difference with all of those parts, hoping that it would pay off. Mm-hmm. So for the entire time I was at Code School, we didn't have a 401k. And then I think Pluralsight acquired us in like November, and we got 1 month of the year with a 401k. And I remember that month, I was like, man, I've been waiting for a 401k for like 6 years. I'm going to set this to 100% of my salary for this month. And yeah, I still didn't max it out that year, but at least it got a little bit closer.
That's awesome. So you had 2 windfalls from the startups, right? The first during the acquisition, the second when it like IPO'd, correct?
Right.
So kind of all in all, you had like the windfall from your family, and then 2 kind of startup windfalls, correct?
Right.
Okay, awesome. And then I'm curious, totally okay if you're not sharing this, during those kind of like 6-ish years of working at startups, do you mind sharing like what kind of salary you're making?
Yeah. So I worked at, I think it probably would have been 10 years altogether with other startups before Code School. Mm-hmm. And it probably started, so I was making between, I think, 66,000 at the start of it, and maybe like 130 at the end of it. So it wasn't Bay Area salaries by any measure.
Yeah. I'm curious, cost of living during those 10 years, did you stay in the house that you inherited from your family, or did you like what was your living situation, and what did you do with that house?
Yeah. So in terms of the house, I fixed it up and sold it over the next year after I inherited it. And that involved like getting rid of a deadbeat tenant, fixing it up, and driving from Orlando to St. Pete every weekend to like work on it while I was working full time the rest of it. So it was a very stressful year. So yeah, I was able to sell it
yourself, or
I sold it with a realtor, and I think I sold it in 2006. But unfortunately, I also bought a house in 2006. So it kind of just negated itself in terms of, money wise.
So what'd you sell it for? And then also, did you do the repair work yourself, or did you pay someone?
The most of the fixing up was minor stuff, so I was able to do it. There were a lot of major problems. This was a house from 1926 that was built in an area of St. Petersburg, Florida, that was for Al Capone's like group to go out and holiday down there in Florida. And it still had the original wiring. It still had like, you know, all kinds of things that made it even impossible to get insurance for unless you got business insurance. So in a lot of ways, I was just happy to say, okay, I need to let this house go before it like accidentally burns down and I miss an opportunity.
Awesome. And what'd you end up selling it for after you put in all that time repairing it?
I think it sold for 250,000, but then it had like a 100,000 mortgage. And then so the money from that I put into the new house. Some of it got put into a down payment on a new house, and the rest of it I was able to add to my investments.
Nice. Awesome. And then kind of again, circling back to cost of living during those 10 years, you know, I guess kind of preface to that, were you like tracking your expenses during any of these 10 years? Like, let's talk about like how, you know, how nitty gritty, like on the kind of the tracking of everything were you?
Yeah, I was tracking it. Some of it I actually like post tracked, like I went back and figured out how to track it. I'm trying to pull something up here. Let's see. And if I share my screen for a sec?
Go for it. I might have to give you permission, but go ahead and try.
Let's see.
Oh, perfect.
Cool.
Look at that.
Yeah, there we go.
This is the first time we've done a screen share. Adam, you're taking us to new levels. Thank you, brother.
Yeah, this is my one slide from this talk. But yeah, this is kind of showing like how the y-axis is showing what my savings rate was in any given year, and the savings multiple. So like, you know, the FIRE way is to save 25 times your yearly spending. So this is based on my yearly spending at age 23, my yearly spending at age 24. And so this is kind of fighting two things. Like, you don't want your spending to rise, and you also want your savings rate to stay up. So ideally, you want this to go up and to the right as much as possible, or at least steady. So this kind of shows like, you know, I inherited some money these years from the initial inheritance and the sale of the house. And then between 2008 recession and my house going about $100,000 underwater that I just bought, net worth dropped a lot, and built it up over a couple years of savings until Code School was acquired. And then this is another down year in the market. And then Pluralsight going public, and then leaving my job a year later.
This is awesome. Do you mind if I take a quick screenshot of it?
Yeah, go for it.
Do you want to be in it, or do you not want to be in the screenshot?
Either way.
Okay, smile for the camera. Sweet. Yeah, this is super cool. It'd be awesome if you could put the years underneath there too at some point, because it'd just be cool to be able to see, you know, the downturns in the market without, you know, kind of like, oh, that was 2008, that was, you know, whatever. But this is totally super insightful, because I don't know what just happened to it.
Oh, sorry. Let's see.
Oh, there we go.
There you go.
Yeah, I mean, you're totally right. Normally you want to like a nice kind of like just curve up and to the right, but this is like kind of all over the place. But it really follows your journey, which is your journey is this kind of like whole like, you know, windfall, you know, just by sheer kind of, you know, luck, and also just kind of being in the right place at the right time. I think it's so awesome that your startup came from a meetup, because one of my beliefs has always been, you know, that these meetups are like a gold mine for, you know, really your FI path. And, you know, yours wasn't traditionally a FI meetup, but, you know, in my own personal experience, I've been incredibly empowered and inspired both me and my fiance from these meetups to like speed up our own path to FI, as well as like our learnings and everything. So really cool to see that like similar situation for you, but kind of like more in the world of tech. And I think for a lot of people who are joining this meeting, a lot of people potentially are in the tech space. I could be totally wrong here. It's hard to tell now with everyone dialing in from everywhere, but that's pretty amazing. So Anna, I'm going to pause because I've been like totally hogging this kind of interview of Adam. Are there any specific things you kind of want him to dive into before I ask a few more questions and then we start to open it up to the audience?
Yeah, we got a question from Steven just about the chart. Adam, it looks like you caught it.
Yeah. The question was about the savings multiple, and probably go into the negative savings rate part too to address what those are. So the idea is savings rate is the savings rate for that year based on, or savings multiple, sorry, is the multiple of how many times your income you have saved up for that year. So for instance, at age 23, that would mean I had 5 times how much I was spending as a 23-year-old person, single person. So I think when I was 23, I was probably only spending like 30,000 a year. So 5x 30,000, 150,000. While this might be 25 times 80,000, which is how much we're spending now. So it's dependent on how much you were spending for that year. And then the negative savings rate, I'm probably going to change this to say like 1% savings rate, 2%, 3%, 4%. So it's more in line with the way that we talk as a FI community. But this was kind of based on the idea that negative 100% is a 4% withdrawal rate. So this would be like a 3 or like a 2% withdrawal rate at 50%. And it is based on the total net worth at that moment, not just the one saved that year, but the savings rate part is the amount saved that year. So with this number, you can know how much you saved that year, how much you spent that year as a percentage of your total savings. Hope that answers it.
We have 2 other follow-up questions. One from Baptiste saying, is 25 times savings 25 times investment? Or actually, sorry, your question doesn't quite make sense, Baptiste. Could you rephrase it? And then Stephen asks, is it savings as in total net worth or saved that year?
As in total net worth.
Okay, perfect. And Baptiste, if you have a follow-up, feel free to restate it. I'm not sure, maybe it was just the way I read it out. It didn't seem like it made sense. Okay, so while we're waiting for that question, I do have one question for you, Adam. So one thing I've always really enjoyed about reading Minify is your perspective being really different from other bloggers that I read. And I also really enjoy the holistic view that you provide. So one thing I would love to hear about was your mindset during this time. So just to give you an example, like I read about how you were talking about, we don't have uber frugality lifestyle. In fact, we spend quite a bit more than other FI bloggers. And it was so refreshing to read about your wife purchasing a Chanel handbag. I mean, sorry if this sounds creepy that I'm like that deep in your archives, but I love reading your blog because it was like, okay, like that is something that I don't think I've read in any of the other FI bloggers, because they're always talking about how they're trying to cut their food spending. They've like cut their gym membership. They're trying to have a no buying clothes ban, so like, can you talk a bit more about your mindset in terms of as you're going towards FI, were you always looking for more opportunities to earn, thinking that you had endless possibility on the earn side versus the savings? I don't know if my question makes sense, but can we just can you walk us through, how you were thinking about the FI strategy of how you're going to get there?
Yeah. One thing that was kind of interesting, and I've seen this in a lot of other people's journeys to FI too, is that it doesn't start with like where they end up as the goal. Like for me, it wasn't like to retire by 36. It was more like when I first, when my mom passed away and I first inherited money, I'm like, well, now when I retire at 65, it's going to be great. And then as I learned about more things, it kind of lowered that age to 60. And then, something else, some other strategy like, let's say index fund investing might lower it to 55. And then learning about tax optimization lowers it to 50. So it's like each one of these steps was kind of easing it closer and closer. And then the windfall for me was what took it from like 45 to 36. And that cut off like 10 years of work right there. But from a mindset, I think for one, my wife keeps me a little sane. Otherwise, I would go much more towards the minimalist route. Be one of the crazy people who's trying to like reduce his possessions down to what he can carry in his backpack or something. But instead, we more go I guess it would be more towards the fat fire lifestyle. As I think our total spending that we kind of target is around 80,000 a year, and that's for two of us, no kids, one small dog, living in an apartment. I think if we owned our house, it would probably be about 40,000 or so, 50,000. But I think some of the mindsets that kind of brought us there still have a little bit of that minimalism mentality. Like for me, one of the big areas is like the buy it for life. The subreddit buy it for life on Reddit. It's a really good place for ideas there. We always look for things that we can maybe pay a little bit more for, but will last a little bit longer. An example is this very odd mouse that I use. And I got this in 2003. It's still going strong. So we kind of look for those opportunities. Even this keyboard, this is the same keyboard that I used at code school for the last 12 years. And it's working. I don't need to replace it. And I have a feeling my wife's Chanel handbag is probably going to be like that too.
Awesome. Justin, do you want to jump in with?
Oh yeah. So this is great. And don't worry, everyone, like we got 2 hours. I will make sure that we get at least 45 to 60 minutes of like crowd driven questioning. But fortunately, being one of the co-hosts of the meeting, I get to like make sure I cover everything I want to hear. So I'm just gonna be a little selfish there. My fiance is looking at me like I'm crazy, but I'm just curious, like you discovered Mr. Money Mustache, you're a bit of a minimalist, but you're also like kind of like more in the fat fire camp. And, kind of those who are unfamiliar with what fat fire is, these are the people that don't just want to like be at the bare minimum 25% of, or the 4% rule, sorry. And essentially want to be able to spend anywhere between 80 and 100K plus versus like traditional fire people are, I think, more around kind of 40 to 60 or 70K. So I'm just curious, like you discovered Mr. Money Mustache, who's obviously super hardcore on frugality. You're a minimalist, yet your wife is into Chanel bags. How do those mindsets all kind of meld together? Because I think I'm still unsure. Like you're saying you're a minimalist, but you're spending 80K a year, and help us better understand that.
Yeah. I think I'm still trying to figure that one out. But I think for me, like minimalism for me means like only buying and using what we need. And I feel like that isn't price dependent. Like you can be like if you've ever seen like pictures of minimalistic houses on Instagram, those are not cheap houses. those are very expensive places that are staged using like super expensive luxury furniture and amazing views. So I think there's kind of two different things. It's almost like this difference between minimalism and frugality. where minimalism is just focusing on like what you use and what you need. And frugality is more like optimizing it for cost. And a lot of the times those are kind of interchanged when we talk about the two of them.
That's super helpful, actually. There's kind of like it's like, you know, there's two like circles that overlap. There's like a middle in the, or there's a part where they both share. That's kind of an overlap, and it sounds like you're kind of sort of in that intersection of those two circles a bit, and maybe you lean out more into one or the other in different areas of your life and different times of your life, and maybe your wife is more in one and or the other, you know, in the, you know, there's the third circle, which is the fat fire circle, and maybe your wife is more up in that one and you play in that one too. So that's super helpful. You know, I think many of us, similar to you, are still really figuring out what our FI journey means to us. I know that's definitely the case for my fiance and I. You know, I personally first discovered Mr. Money Mustache, and I went like hardcore frugal. And she was like, whoa, you're making my life miserable. And she kind of brought me back to making really kind of, I think, more where you're at, which is like, you know, what is really important to us and how do we spend money for like investing in having like the best life possible. And like, I love the buy it for life mentality because, you know, I'm just going to say it. I'm a huge fan of Apple, and I have the newest iPhone because for me, this is like the tool that I use every single day. And I want to have like the best tool. Like I do all, like most of, like much of my work on it. Yeah, I think sometimes those of us in the FI community get so frugal that we frugal ourselves into a corner and kind of sacrifice our quality of life. So it's really, really refreshing to hear from somebody like you who's kind of striking this middle balance of being minimalist, frugal, but also like, you know, a bit of a fat fire. Like you want to have a life that's really, you know, one of high quality and enjoyable. I'm curious, did you have any struggles where you were like maybe being too frugal and you had to kind of like pull yourself back, or your wife did? I'm just gonna pause and see.
Yeah, I think kind of like you two, we had a very similar situation where I went way too far after learning about Money Mustache and cutting my, like, it wasn't just my expenses, it was our expenses. And her pushing back and saying like, I think this is too much. Like, I'm trying to think of an example, but I remember like even getting to the point where we were like using the local energy company to come in and do an energy audit to lower the wattage of our house so we could lower our bill just a little bit. We were like, I was just constantly looking for ways to cut money.
Yeah.
So yeah, it went too far. I think for me in a lot of things, I don't know how far to go until I go too far, and then I have to reel it back and find a good medium.
Yeah, I'm totally the same way. I'm curious, you know, do you have like maybe any advice for kind of like people that are in a relationship? Because, you know, I know there's probably people on here who are trying to get their wife or husband or significant other on board, kind of with the FI thing. And, you know, maybe they're running into roadblocks because, you know, that was a big part of our journey, is like, how do we like make this fun for the both of us? But I'm just curious, you know, any learnings you could share kind of around, you know, getting your partner on board, or like do's and don'ts, like, hey, here's some things you should not do because they were terrible, you know, in the way that I did them and would not recommend.
Yeah. Let's see, I'm trying to think of things that worked and didn't. I think things that worked or things that didn't work were making things a request instead of a conversation. I think it's better to make it a conversation first and get on the same page about how you're going to tackle something together, rather than one person coming and saying like, hey, I want you to get on board with this, or I want us to start doing XYZ, and introducing it in a different way where it's more of like, hey, I've been reading about this one thing, and I think I'd like to chat with you and see what you think about it. Might be some way we can work this into our lives somehow. And then you come up with a plan together. So I think that's one thing that I kind of had to learn the hard way, instead of coming at it like I might as just, ramming it down someone's throat.
I absolutely love that. I think that's just great relationship advice, period. No matter what it is, whether it's FI or anything else, is having a conversation around something versus a request, and getting their input before making any sort of decision. That's that's great. I'm curious, kind of a little bit more about your wife. Like, when did she kind of get on board? How did she get on board? How on board is she? And sorry to ask about her, and she's not here. I just know, for me personally, and just also in my experience talking to so many FI people who are either in a relationship or looking to be in a relationship, this is a huge concern. It's like, how do you make it work for two people?
Yeah. And my wife and I have very different career paths. Like I was a software developer, product manager. She's an English major. And so we've kind of thought about like what FIRE or what retirement would mean to us in very different ways. As a software developer, you can usually like leave a job. You can easily find other ones if you're a software developer, or do some of your own work. In a lot of other career paths, it's not as easy to just jump around. And so a lot of it's building up and growing within a company. And so I think one of the differences in our paths was that I think it, for her, was more like, well, maybe someday I'll want to take a break from work, and then I'll, use a break and then go back to something. So she actually left her job January of this year, which was a good time, because if she had started out, or if she had left later on, she was working in like travel industry, so it would not have fared well in 2020. But luckily she left before that. And I think like even how we think about it now, I think about this as like, for the rest of my life, I'm going to figure things out. And I think she's more thinking like eventually go back to work or work at a volunteer organization as a long-term thing going forward.
Awesome. So you would say she's like, you're kind of like the more FI person, and she's like, I'm down for it, but she is a bit more interested in, working, and you're a bit more interested in maybe working, but only on things you're super passionate about that may or may not make money. Is that kind of a correct analysis?
Yeah, that sounds about right.
Okay, cool. So yeah, when like I'm just curious, when did, like, are you guys like maybe I can or can't ask this, so please, if it's not appropriate, you don't have to answer it. Like, is your money mixed or is it not mixed? And like, are you guys like FI together, or only you FI?
Yeah, that's a really good question. So our money is mostly mixed. I have like one investment account that's about a quarter of our income that's still like in a personal one. Not for any reason other than to migrate it over would have some tax consequences. Mm-hmm. So everything else is able to be like mixed between the two of us. And one thing we do is we use Simple as our bank. Really nice online bank, by the way. And they have individual and joint accounts. So we have a joint account and we have individual accounts that are linked to it. And in all three of those accounts, we have 1 year's living expenses. So she has 1 year's living expenses that I can't access. I have 1 year's living expenses that she can't access. And we have our joint account, which is where we really just live off of.
Awesome. That's super cool. Wonderful. Anna, I've been like hogging the convo. Do you have any questions? And then I'm going to ask my fiance if she has any questions. And then we'll start to open this up to everybody in the online and what people posted.
Yeah, so my questions are mostly related to the questions that people are already posting, so we can dive into those pretty quick. But I think the one thing that I was curious about, Adam, is looking back now, what did you think about the strategy of going with the startup life? Because it has some of the downsides of not having a lot of cushy benefits that other people who work in software might have, like a really generous 401k match, things like that. And then, of course, you're giving up that safety for the upside, which you were able to enjoy, right? So if you were looking back at it, you know, and counterfactuals are always unhelpful because you never know how it would have worked out. Maybe the startup wouldn't have eventually gotten acquired and then gone public. But for folks who are looking at it from their shoes, where they're in that process and they're trying to think through, I'm looking for a job, let's say next year or in 2 years, which strategy should I pursue? Should I try to go for the high risk, high reward strategy, or would I be better off, getting a job at the best software firm I can? Can you talk us through like how you would think about that?
Yeah, there's a lot of variables there for sure. And let's see where to start. So I think for a lot of people, myself included, there's almost like this mentality for startups where you like really like the idea of knowing the entire business. Like you wouldn't go to Google and say, I want to know the entire business. You would specialize and work in a specific department. So I feel like the people who would be more likely and get the most out of the startup approach are the people who really want to know everything end to end. If you like being able to build something and go from the very first commit to, customer acquisition and worrying about marketing and lawyers, then the startup side has a bigger calling. But even there, it depends on where you live. Like, are you willing to relocate? And one of the things that I realized kind of later on, looking back, is that I would choose what startup you work for or what startup you start, if that's your approach, the same way you would invest your money. Like if you wouldn't like invest all your money in this startup, then you shouldn't work for it if that's your plan. But if you actually find a company that you think is a great investment, like you think this startup's going to go to the moon and there's almost no way it's not, and you would actually put your money behind it, then it makes sense to put your time behind it. But if it doesn't, then I think if you can't find that, and that is very elusive. I have never been able to find that a second time. That's how elusive it is. If you're not able to find that, then I think the large company approach is a better route.
Interesting. And quick follow-up about that. Did you find that because you had a higher risk job that your investment strategy was more conservative to balance that out? Because I have heard some folks will do that just to equalize the risk that they're taking on in all aspects of their life.
Yeah, if I hadn't gotten a windfall earlier, I don't know if I would have pursued startups, because I might not have had that like financial security to back me up in case I failed or in case the company failed. I think like I was kind of leaning on it like, hey, if this company fails, I'll just go get another job somewhere else that I don't like as much. And if you're in that position, then at least you have some backup, as long as you also, get an emergency fund 3 to 6 months and kind of fulfill those basics first.
Got it. That's really good advice. If you're going to take the risk at the startup, make sure you've got the emergency fund in case they go bust without warning, right?
Yeah, for sure.
Okay, great. Justin, if you want to ask, or Carly, if you have any questions, and then we can jump into audience questions.
Yeah, we're good on our end. So let's start, answering the questions from the audience. And Adam, thank you so much for talking with all of us, and really appreciate you. And audience, thank you so much for being patient as Anna and I kind of like pulled out, some background information, some origin story, as well as kind of just personal questions we are curious about. So now let's cover the stuff that you guys want to cover.
Yeah, so I think the top questions that everyone wants to know about is what you're doing for health insurance.
Yeah, so I've been retired for 2 years. In the first year, my wife was still working, so we switched to her plan. So in January this year, we switched over to a plan that we found through healthcare.gov, and we chose a high deductible plan since we're both relatively young and in good health. And so we got one that has an HSA that we're able to contribute to as well. And one of the more controversial subjects in the FIRE community is for healthcare, especially ones from healthcare.gov. If you make below a certain amount, you can get a subsidy. And so I think for different people, that's different amounts. But for us, that means that we pay $250 a month for our health insurance. And it's a high deductible plan. And so if we go out of network, we're going to be paying larger amounts. But it's through the University of Utah, which has hospitals, doctors, and a ton of stuff. So we just got all of our vaccinations, our yearly exams, all of that, and it was all 100% free, covered by our regular deductible. And without that rebate, it would have been, I think, $600 a month. So it's like a $350 rebate if you make under $65,000 a year.
Got it. And then we all are curious about your asset allocation and what you're invested in now. And is it different from during the accumulation phase? Because now that you're in the withdrawal phase, maybe things have changed.
Yeah. So one of the big concerns with asset allocation right around the time of retirement is this thing called sequence of return risks, where if you retire in a year, let's say you retire in 1929, and then the market drops right then, it's going to be very different than if you retire, just as the market's recovered. And so kind of to help negate that, we switched from having a 80% stock allocation with 20% bonds, which was what we did through most of working career. About 5 years before pulling the trigger on retirement, we started amping that up to where it was 60% bond, or 60% stocks, 40% bonds. And that's where we're at right now. And the hope is that in the next 3 years, it'll go back up to about 80% stocks. And I think Michael Kitces has an article on this called the bond tent. It's kind of the idea that, your bonds are slow and then they go up right as you get to retirement, and back down over the next couple of years. So it looks like a tent.
Great, thanks. We had a good follow-up from TNK asking, did you factor in long-term healthcare costs into your FI numbers? Meaning, did you start to think maybe as we get older, we'll need to put more aside for healthcare? So factor that into your planning.
Yeah, our actual healthcare expenses when we were planning them ended up being $1,000 a month. So since we're only paying $250, we've actually been way under that. So I'm hoping that between the difference in that and the growth in our HSA between now and, let's say, 65 when we get Medicare, if it's still around, or hopefully Medicare for all happens before then and we won't have to worry about that. But between now and then, we're hoping that that growth plus the difference can help those long-term parts, later in life when our healthcare might be triple or quadruple the amount it is now.
Great. And one thing I'm curious is, did you do any special tax planning to prepare for when you sold your stock and pulled the trigger on early retirement? I know you mentioned earlier that because of windfalls, all your big lumps of money end up in brokerage accounts, and that's somewhat trickier when it comes to future planning, because you want to make sure that when you put that money in the market, you're confident about where it's going. Otherwise, to fix any mistakes, it's going to cost you a lot to sell and then rebuy and have a tax burden. So what kind of things did you think about in that process, if any? And did you hire a financial advisor to help you?
Yeah. So I didn't have a financial advisor, but I had a CPA and like an accountant who were helping on that side. And every time I asked about like things I could do to lower my tax bill, they're like, nope, this is it. But one thing that was kind of neat, I'm going to share this in the chat. It's this equity compensation guide about startup equity. So like really, really good. It's basically an 80-page book about startup equity, and it goes into avoiding or minimizing taxes based on what type of equity you're granted, whether it's RSUs or stock grants or options. And in our case, the way that ownership worked of Code School is that we didn't actually have any of those. Everyone just owned a percentage of the company. And so whenever anyone's talking, you're like, you own X percent, you own X percent. And since we never took funding, that never changed. It was never diluted. And we never had a taxable event where our things were vested, but we weren't able to pay taxes on it, which is one of the biggest hits that people get hit by right now when it comes to startup equity.
It's also nice because it means that since you probably worked there for more than a year, it was considered long-term capital gains when you sold, right? So you would get a much lower tax rate.
Yeah, exactly. And one thing that was kind of unexpected was, the startup equity I had was turned into shares at this company that went public, and then I sold those shares 6 months later. So one of the big questions I had was like, I've only owned shares of this public company for 6 months. Is that considered short-term capital gains or long-term? Because I've only owned the stock for 6 months, but I owned the underlying asset for years since the start of the startup. And it turns out that is a long-term capital gain, even though you've only held the stock for a short amount of time. So there's some nuance there that are dependent on your individual circumstances.
Great, thanks. And I have one more question, and then I can turn it over to you, Justin, and we can field more questions from the audience. I'm curious, not everyone on this call is in tech, and not everyone in this call is working for a startup. So if you were thinking about windfall strategies in general that are under your control, being someone who no longer works at a startup and is not actively working as a developer right now, what kind of things would you pursue if that was the FI strategy that you wanted to add to the mix? Meaning, like, would you go out there and start your own company? Because you could, now that you've got that experience behind your belt where you've seen that process go through, or would you continue to try to look for that elusive startup that you mentioned? Or would you, I don't know, go into real estate since you had some experience with fixing up and selling, right? Do you have any ideas about what you might do if someone asked you, hey, Adam, I want to pursue the windfall strategy too. What do you recommend for me?
Lottery tickets, 100%. No, I'd probably recommend working at a company that you can get the most amount of experience that'll help your long-term earning potential. So that company might be a big company, it might be a small company, but it's one that lets your experience grow, lets you learn more, so that in your next job you'll be able to learn, or you'll be able to make even more. And while you're learning there and growing there, start being on the lookout for those potential, diamond in the rough companies that you could jump over to. And you might not see any for years or even a decade or maybe even never, but even if you don't see one, you will have increased your earning potential by growing your skills at that first company.
That's
Great.
awesome.
Yeah.
I'm just going to add some follow-up questions to that specifically. I think one of the big challenges a lot of people fall into is they get so focused on making more money and saving more money that they forget to enjoy the journey. So in terms of kind of like what you just talked about, like, both from your personal experience and then also from your kind of advice coaching experience, like, were you pursuing like passion and fun over kind of earning since you were kind of taking a risk at these startups? Or were you like, strategically like, I want to get these awesome startup, skills so that I can then parlay it into higher earning later? Like, walk us through kind of both the, your personal around passion and fun versus earning, and then also your kind of like recommendation.
Yeah. For me, it was always leading the way with education and experience. Like, I think even from college on, every company that I went to work for, I was going to work for because I actively wanted to learn from the team there, the people there, the company there. And even when I joined code school, I got a offer to join. I came in and I met with Greg, the founder, my first like intro day, and he's like, "Did we ever talk about how much you were going to make?" I'm like, "Nope, I'm good. Just tell me how much." and that ended up being like, they ended up giving me a good salary, and they ended up giving me good startup equity. But I am an awful negotiator. Like, don't follow that advice. But it kind of shows like I was at least leading in the way of education first.
And for you, is learning kind of like one of your top fun, like that is super fun for you if you feel like you're learning and growing?
Yeah, I mean, for me, it's usually working on side projects that let me learn something while I'm doing it. Even if that side project it doesn't have to be about making money. It doesn't have to be about having an audience or anything. It can just be a side project that's just something that I want to build for the hell of it. And a lot of those I'll get to the point where it works. I'll be like, well, that was fun. And then just move on to something else.
Mm-hmm.
I think that a lot of developers do that too.
Yeah. No, I think that's super cool. I think for kind of the audience and maybe people who aren't so specifically like, I like, similar to myself and you and others in the audience, learning can be super fun, but you can also, if learning doesn't sound fun, that's probably because you're not learning the things that really excite you. So just kind of as we all pursue this path of FI and really life in general, like if it's not fun, like for you personally, then why you're doing it? And there's a million ways to make money, and there's a million ways, to work. And so like pursue work that does both. It grows your, your income, it grows your passion and your interest, and it ultimately, empowers your own learning and development. Because I think humans in general, when we feel like we're growing and we're growing in ways that are fun for us, it's a really awesome life. So I love that you were like, I just want to like jump into the startup and learn, and I don't even care about the money. I think you got super lucky there. For those of us who maybe aren't as lucky, it's kind of like finding that balance of, becoming a good negotiator and making sure you're getting a fair market value, whether that's through equity or salary or a combination of both, while also pursuing like companies that you're really passionate about, like Adam did. I mean, pretty cool that the company formed out of a meetup that like he was going to for fun and learning. So super, super awesome. Anna, I'm gonna turn it back to you for some questions from the audience, and then you guys know I got tons more.
Okay, perfect. Let's see. I have a question here about uh, for folks who are on W-2 income, if they're receiving two 2x year bonuses, how do they keep their income lower? I'm sorry, Kyle, if I'm not explaining your question very well and that you're on the call, feel free to, let me see, are you on there? Kyle. Okay, Kyle is not on here, and I think I butchered his question, so I am not super sure what he's asking here. So let me just change to another one. Someone asked about your hobbies. Do you have expensive hobbies or anything that you enjoy doing that's pricey?
Some of them have stopped since COVID, like going to CrossFit or something. I'm definitely not going to be doing that now. This year, instead, I'm trying skiing, which I am really, really bad at. So I'm hoping to learn, and at least that's out in the mountain, away from people for the most part. I think this year they're doing like every ski lift that goes up. They're doing a individual carload. So whoever you rode in with is your ski lift up. That's probably my most expensive habit this year, other than my personal website, which is not a money-making website. It's just one that costs me a lot of money every year.
Got it. And what do you do on a day-to-day basis now that you are FI? And maybe you could explain like a day in the life before COVID and after.
Yeah. I think one of the kind of almost shocking things from me and a lot of people that I've talked to that have retired early is that we think that the day is now going to have 8 or 9 extra hours of productivity compared to what it was before. And in reality, it's usually been, in my case, taking most of what your day was and just slowing it down. And instead of like running from thing to thing using alarm clocks and being like, you have to go do this today because otherwise you won't have food tomorrow. You have to go to the grocery store today because you won't have food tomorrow. You have to go to the gym today because tomorrow you have to run errands somewhere else. It's more just slowing it down and taking in each day a little bit more at a comfortable pace. So for me, that looks like waking up and having coffee and breakfast in bed with my wife most days. Usually I'll program or write some in bed while she paints with watercolors in bed. That's what she's been doing for her hobby lately. She just mailed out Christmas cards that she drew and watercolored herself to all of her friends. So we were both like working on our own little projects next to each other. And that takes up a lot of time. And lately I started volunteering with a coding organization that is like under the Andrew Yang umbrella for like helping volunteers organize. And so like those little fun projects have been in line with my current interests of like coding and writing and FIRE.
Cool. Jim is asking about passive income streams and what are your thoughts on having multiple passive income streams? Do you have any?
I do not. I'm always in awe of people who have side hustles or like have a blog or a side project that makes money. That's never been my approach, but kudos to anyone who can do it. I've always, so far for me, all of my income has just been straight from investments.
Got it. And he also asked a side question, what is your definition of expensive web hosting?
I think for a personal project, expensive web hosting is anything over about 15, 20 bucks a month.
Perfect. Okay. Someone was asking about getting support. So when you first started, I'm not sure if you were in that chart you showed, if you were married or not then, but at the time, you were going through quite a bit of financial education, and then of course the loss of your mom. Did you have people you leaned on to talk to? And then while you were working also at the startup, other than your coworkers, did you were you able to get support from people on the journey?
Yeah, so in that first year after my mom passed away, that's when my wife and I started dating at that point, and then eventually married years later. So for a while we were dating, our finances were separate, and then joined once we were finally married a couple years later. From a support standpoint, one thing that was actually rather fortunate was that the financial advisor that my bank set me up with, he was actually a really nice guy. I felt like he was sad he had to take advantage of me like he did. But I was able to like sit down with him, just ask him tons of questions, learn about diversification, like asset allocation. So I was kind of like bouncing ideas off of him as, I was trying to get my 1% advisor fee out of him in education. So yeah, that definitely helped.
Great. Okay, so I think Kyle elaborated on his question, which was, how would you recommend someone reduce total taxable income while on W-2 income that includes a comprehensive bonus structure, payouts twice a year? So I'm going to qualify that and say, like, none of us are financial advisors, and I don't necessarily expect Adam to know the answer to this. So, like, take it with a grain of salt.
Yeah, I think there's a lot of steps there. Like the ones that I know of are mostly around like maximizing 401k. If you're saving for kids' college, using like 529 plan. If you're using an HSA, maxing that out. Pretty much taking advantage of all ways you can save money for retirement. Probably the next step would be talking with an accountant if you wanted to move some of that money into like a business expense of some kind. I haven't gotten into that realm, but I know there's lots of ways to do that, but I'm not an expert in any of them.
Great. It sounds like you track your income still. So there's a couple questions about how do you track your annual expenses, and do you have any recommendations for tools that you like?
Yeah, I feel like over the years I've tried like every tool, like Mint, Personal Capital, You Need a Budget, like just using a spreadsheet on my own. And the one I really like that I started using just over a year ago is Tiller. And so Tiller, you connect all of your accounts to it. I think it's like, I can't remember. It's under $100 a month, $100 a year. I think it's like 50 a year, maybe 35. But anyways, you connect all of your accounts to it, and it feeds transactions from all of those accounts into a Google Sheet. And then from that Google Sheet, it has tools to like auto categorize it. You can manually categorize transactions in there, and then it can build reports based on that. And since it's a Google Sheet, you can create your own sheets that like pull in data from other sheets and build your own things on top of it. So it kind of saves any steps needed to like download transactions from Mint or Personal Capital, and instead lets you like just start at that point where you're already able to just play with the data.
That's awesome. Cool. Some people have similar questions to me, and there are a couple things I want to clarify. So first, besides Tiller, other like awesome resources that you would recommend for anyone new to FI or even middle or end of the path, things that you think are just like super valuable, obviously Tiller being one of them, but what else?
I really like Personal Capital for tracking my investments. One of the nice things about Personal Capital is that you can also manually add your holdings to it. So you don't have to connect Personal Capital to your Vanguard account. For me, that's a little bit scary, saying, hey, random website, you have access to all of my money. So instead, I manually enter some of those data straight in. But then it does things like allocation analysis and lets me easily see like how much of my portfolio is in US versus bonds to see if I'm staying on track. And then other than that, I just invest pretty much everything straight with Vanguard or I use Fidelity for my HSA. And yeah, Fidelity has a good HSA plan that's free and lets you invest it in index funds. So I have my HSA in VTI, which is the same as VTSAX, just a US total market plan.
Awesome. So how about books and blogs and podcasts, that you recommend? Obviously your own, but I'm just curious, other resources that you think are really good.
Let's see. Man, there's so many. I feel like I wrote a post about going to FinCon last year and just linked to like everyone that I know, because it's just such a huge community of bloggers out there. But lately, some of my favorites have been Accidental Fire. Let's see. I was like Fire Millennials, Purple Life, who you talked to just recently. I still listen to Choose FI. I've been listening since the beginning, even though now they're like an empire at this point. And Mad Fientist podcast is always good. Since he's also a software developer who retired early, I feel like a lot of the things that he's doing now, since he's like, I think 4 or 5 years into retired life, it's almost like a snapshot of what's coming up for me. So I like reading his stuff for sure.
That's awesome. How about any like books or any that you would recommend to people?
That Holloway guide to startup equity I shared in the chat is a big one. Boglehead's Guide to Investing is a great one for like tax optimized investing. And Bogle's Common Sense Investing, and I think his other one about index fund investing they're all kind of saying the same thing. They're all saying like, just don't look at the news, invest in index funds, and just let it go from there. Yeah. But sometimes hearing the same thing over and over again helps it really sink in.
Couldn't agree more. Repetition is the mother of skill. Some people have been asking this. I'm curious too. What was your net worth at the time that you pulled FIRE, if you're willing to share? And what's your net worth now?
So what was funny was that the day I gave notice was the peak my net worth has ever been. It was hilarious because like I had a lot of money in the company stock, and like most people, when a company goes public, there's a 6-month waiting period before anyone can sell their stock. And so I gave notice in that window with the intention of selling my stock like as soon as I was able to. And like a lot of companies, as soon as a lot of people were able to sell their stock, the stock fell a lot. So I think at the moment I gave notice, we had like a 2.6 million net worth. But on my last day of work, it was down to 1.7 million. So it dropped a pretty significant amount. That was also in the end of 2018. And the end of 2018, the stock market dropped like 20% during a month. And then like by January, February, it was back up to where it was before. So we were fortunate that, very, very quickly it balanced out. And since then we've been somewhere around 2 million to 2.3 million now.
Awesome. Curious follow-up question, like how much cash do you carry on hand? I know you had the 3 different accounts of 1 year spending. I don't know if that's the 80,000 Fat Fire number, or if it's different, or if there's additional money in cash somewhere else. I'm just kind of curious, like, what your cash carrying habits are.
Yeah, that's pretty much the entirety of it. We keep 3 years cash on hand. And the hope there is that if the market did go down a lot, we wouldn't have to sell anything to pay for our normal living expenses for the next couple of years. And that would hopefully give things enough time to rise before we started having to sell investments to pay for our day-to-day expenses.
Yeah. And is
So,
that still based on 80,000 a year?
yeah, that's kind of our target. And it's looking like for 2020, we're going to be a little bit under that. And that's without travel. So it kind of makes me wonder like how much it would have been if we were actually traveling this year.
Mm-hmm. Awesome. And I'm just curious, any plans to buy a house? A permanent residence, and it's tied to like how much cash you're carrying, because obviously you have to have a certain amount in cash to either purchase a house or get a mortgage. The 20% down. So yeah, any insight there?
Yeah, we bought a house in 2006, and then we sold that one in 2018. It was for a loss after 11 years. So that tells you how bad I am with houses. So that kind of turned me off to housing for a while. So we've been really enjoying living in an apartment where we can just put in a ticket with the apartment company and they'll come and fix anything. So right now we're in no rush, but I think we've lived in Salt Lake City for 3 years, and we just renewed our lease for another year. And we're thinking after that, we'll probably want to move. We're thinking out west. We have a lot of friends in Seattle, so we're considering moving out there. I have a feeling we would rent a couple years and learn the area, and then start making a decision if we wanted to actually buy or if we wanted to just keep moving to new places. So yeah, no time soon.
Awesome. And two follow-up questions. How old are you now? And are you and your wife considering kids at any point?
So I'm 38. My wife's also 38. And yeah, no, we're planning on going the child-free lifestyle. Yeah, no plans on kids for us. I had a vasectomy last year, so I think it's pretty safe.
Appreciate you sharing all of that. Apparently, Anna just texted me and said you wrote a blog post about that. Is that correct?
I know I've mentioned it a couple times. I have a page on like beliefs, and one of them was like personal beliefs, and one of them was around that decision to go child free.
Awesome. Cool. Anna, I have more questions, but I want to pass it back to you to crowdsource some more as we're starting to approach the last 30 minutes of this. And Anna, are you okay on time? Like, it's okay if we take you for the full, you've already been talking for an hour and a half, pretty much. Like, I just want to be super respectful of your time and energy.
Oh, I'm fine. As long as people aren't bored or want us to talk, or if your meetups have discussions.
We got 45 people here. They can drop off whenever they want. So if you're down, we'd love to have you.
I'm down. I mean, I got on a shirt for this. I'm ready.
Yeah, we keep getting a deluge of questions. So I think Justin will agree it's one of the most engaged meetups we've had. So thank you so much, Adam, for coming and joining us. I have a question from Wendy. It's about ESPPs. She asked, is the general consensus to sell your ESPPs as soon as possible? I don't know if you have an opinion about this.
Yeah, so we had an ESPP at Pluralsight, and I kind of made it a small obsession of mine to learn everything I could about ESPPs. So this is actually one I know. Let me share my screen here for a second.
God, you're so prepared. I love this. I'm going to recommend that our next guest speaker, if they want to screen share, they can do this, because this is just making it even more rad to do this virtual meetup.
So let's see. Can you see my screen okay?
Yep.
Cool. So yeah, the question is about ESPPs, and do you sell them immediately, or do you like take that stock? So as a quick primer on what ESPPs are, it's employee stock purchase plans, and they usually allow you to buy shares of your company, either public or private, at a discounted rate for some period of time. Kind of the usual thing is that you get some kind of discount rate, so you're able to buy it for that much under what your basis amount is. And that basis amount is usually like, at the time you sign on to the ESPP, let's say January 2020, then you lock in that price as of January 2020, and you can buy it at that price with this discount for up to some period of time, maybe 1 year or 2 years. So let's say in 2 years, it started at $10 and then it rose to $20. If you sold it at that point and you maxed it out, the most you can do is 25,000 in ESPP, then you would have paid $25,000 after tax. You would have gotten 33,000 in profit, paid 7,000 in taxes, and resulted in that much profit. So this is kind of the example when like the stock goes up. If the stock goes down,
awesome that you're walking us through this. I just got to say, this is really cool. Thank you.
If the stock goes down, you're, instead of getting 15% off of 10, now you'd get 15% off of 5. So you're still buying the stock at a discount. So you're buying the same amount, basically $25,000 of stock, but now you're only going to make some percentage of this discount that you had after taxes. So kind of the question was, do you sell it immediately, which would put you in this tax bracket of whatever your ordinary income tax rate is, or do you let it go to long-term, or do you hold on to that stock? In which case, after a year, it'll turn into a long-term capital gains at 15%. And for me, it's always been like, I just want to sell it as soon as possible and transfer that money into VTSAX or something like that instead of tying it up. I think if it was a very small amount of your total portfolio, then it might make sense to keep it as more of a speculative investment. Like let's say you have $1 million invested and 25,000 of it's in your company stock, or 50,000. That's a much smaller percentage of your total portfolio that you're speculating with. But yeah, I'd highly recommend just selling it immediately if you can.
And Adam, since you're sharing your screen now, would you mind showing us your retirement calculator? Because I believe Chris is on the call and he loves Monte Carlo simulations. So I thought that it might be a good chance for you to walk through it for folks in case they wanted to know. And Chris, if you have questions, this is a good time to ask.
Also, happy birthday to Chris. It's Chris's birthday, or it was yesterday or something. So happy birthday, brother. Thanks for doing this.
Appreciate it.
Happy birthday, Chris. Yeah, so this is something I built in September. I never knew how Monte Carlo simulators work, so I wanted to build one and understand it. And kind of the idea is, so there are two main types of calculators when it comes to early retirement. There's ones that take into account all the current sequence of returns and use that to project the future. So, you invested $1 today and the date is 1950. What if that dollar was invested in January of 1950, February, March, April? And that's the approach that things like CF Fire Sim, I think, or some of these other ones use, or FireCalc. Let's see if that still works. Yeah. So ones like FireCalc, for instance, they both use this approach, as does most of the writing that early retirement now does. It's all based on, if I were to forecast this, I would look at all the previous sequence of returns. Kind of the other route is a Monte Carlo simulator, and this instead randomizes all the years or all the month gains between some start time, 1920, and today, and tests your future based on those scenarios. So there's a lot here. So let me slow down a bit. So let's say you wanted to invest $1 million and see what it could look like in 30 years, let's say with zero spending. And let's assume your total fees are 0.5%. It's in a Vanguard index fund. And let's say it's zero cash on hand. So it's 100% invested in the stock market and 0% of it's in cash. If you were to do that, then over a 30-year period, using this scenario, 100% of scenarios are going to work. So obviously, that's a very different result than like a CFI or SIM result, where it would probably say like 98%. And the reason for this is that when you look at the results by year, even in the worst case, it's giving like a 10% decline the first year and like a little smaller declines for future years, but it does still grow. While in a worst case sequence of return, it might actually be 10% down the first year, or 40% down the first year and like 10% down the next year. So like the worst case, like the 0% case, that's when you get into like, there are like 3 scenarios where it fails and the rest of the scenarios, it doesn't. So for instance, if we did 100% stock with some cash on hand, and go back a little bit longer, seems like everything's working. Oh, no wonder, I'm not doing any spending. So you actually have to spend money to draw down your money, apparently. So if we turn this up to 40,000, that's when it starts to fail. Because now the results by year, you're taking money out as well as the market going down.
Hey, Adam, would you mind running your numbers on this with your 80,000 spending and your starting amount? Like, I think it'd be really fun for us to just see like your own calculator or your own simulator on your own journey.
So let's see, we have about, let's say we live till 90-ish, and we have 80,000 a year. And our fees average about 0.8, let's say 0.1. It's pretty much all Vanguard, but some Vanguard funds have higher rates, including our bond fund. And we have 160 on hand. And we use a 60% stock bond portfolio. And using data since 1872, it's 80%. I tend to look at since 1920.
Why do you look from then? Help us understand that.
So between 1872 and like the early 1900s, cash had a very high return rate. A lot of the times, if you had money in cash, you could get 10 to 20% a year just in a savings account. Part of that's inflation also. So the markets kind of really started closer to 1920 to get a more realistic look at today's economics.
Gotcha. And then someone had the same question I had. We thought you had 3 years on hand, which is 240.
Good call.
Cool. So make sure we're running the real numbers. Make sure Adam's not going to run out of money.
Yeah, we have a greater than 10% chance of this failing, which probably sounds like a lot. For us, like if we did start noticing ourselves in this bottom 10%, we would probably, I'd probably not go skiing that year. My wife might not buy a Chanel bag that year. We would reduce expenses a little bit to try to get back on this higher trajectory.
That's awesome. And then like, maybe I'm the only one confusing the crowd. How would you kind of notice that you're like not on the higher trajectory and like, oh crap, we need to reduce spending a little bit? Like, how would you actually like, as you're living this journey, do that?
I'm just going to mistype everything today. So one thing that we do is we track our savings rate over time. And we have a like savings rate for the month and our savings rate at a 12-month moving average. Or this is what we did while we were working. Now that we're not working, we do the same thing, but with our withdrawal rate for the month. So we have our withdrawal rate based on the past 12 months and our withdrawal rate based on like if we used last month's spendings times 12. And so this lets us see if it's going, instead of these numbers, it would be like 4%, 3%, 5%. And our goal is to stay under 3.5%.
Do you have a running simulator on this, like where you can like track it?
I don't. I have it all in my personal. I have it all in my personal spreadsheet.
You got to build that. It'd be an amazing tool for people that like who are actually like, you know, in the FI portion of their life and just want to kind of have a tool to guide them. This is awesome, dude.
Yeah. So thanks. Well, what we try to do is kind of look at it and see if our withdrawal rate is getting above 3.5%, and in which case we know like, hey, maybe we're on that bottom line from the chart, and that's when we start like looking for ways to either cut money or cut expenses or optimize something.
This is awesome.
Go
ahead, Chris.
Do you use completely random selection of returns, or are you just shuffling the returns?
It is a shuffle of the returns, so it doesn't use the same years multiple times.
Gotcha. Okay. And then I guess so the concern I have with the Monte Carlo I've made in the past is, especially for bonds. I mean, like, and you kind of mentioned this before, like return rates on cash used to be much higher, especially, and same for bonds. Bonds used to have much higher returns. And so eventually I just switched to just generating all of my own random returns rather than using historical ones. I was wondering if you've had any issues with higher than expected returns.
That has been a concern. And it's one of the reasons why when it was running initially and I didn't have the spending on, I'm like, why is it working? I'm like, oh, it's probably just because bonds were doing really well or something. And I feel like right now with the bond rates as they are, it's hard to imagine a time where bond rates are ever going to return to where they were at some of those early years. I don't have a good answer for it, but I think I'm running into the same problem that you were.
Yeah, eventually I just switched to, I generated my own returns, which all have like geometric averages within like the range of the last like 20 or 30 years for bonds. But yeah, obviously things could change again in the next 50 years and bonds could go up, but I also don't see that happening.
That's a good idea. Maybe like use whatever your look ahead time frame is as the look back year for that geometric range.
Right. Yeah.
Cool. Yeah. So you built a Monte Carlo simulator as well. Like what was that like?
I did. It was pretty good. I'm not a software engineer. I'm a mechanical engineer. And so mine is all based in Google Sheets. So it's a little less visually appealing. But yeah, I've been using it for a few years now, but mine is based off of I have like a life finances spreadsheet. So the whole thing all can go through the Monte Carlo simulator. And so I can tweak a lot of things to say like, okay, well, if I were to reduce this particular type of spending, how would that change it? If I were to change how I do my taxes, how would that change it if I have like more tax advantage accounts in the future? Or if I decided to, there's a lot of different, I kind of made it to where I could change any particular feature for it.
Nice.
Chris, your COVID hair is crushing. Chris used to have this like super cropped, like, nice, clean do, and now he's growing out. He's growing it out. I like it. He's getting wild.
Exactly. Just letting the COVID grow out.
Boom. Awesome. Well, this is so rad. I love that we can screen share and people can jump on and dive deep into the weeds on this. Awesome. So we're starting to approach the last 14 minutes. Anna, are there, actually real quick before I totally forget, I always do a screenshot of everyone who wants to be on video. for, social media picture and my Instagram account and the Facebook groups, etc. So if you want to be in that picture, put your screen on. You don't have to say anything. If you don't want to be in that picture, keep your screen off. So I'm going to go to gallery view, and then everyone smile for those who want to be on camera. And then I will do a little countdown.
Oh.
Let me get this. Oh, Matt Caesar's even coming on, showing that epic beard. Cool. Awesome. Everyone, 1, 2, 3, cheese. Awesome. Cool. So if you want to go back off video, because you don't want to be on the YouTube recording of this or wherever we put it, shut your video back off. Anna, I'm going to throw it back to you for maybe one question or more, and then we're going to start shutting this down.
Yeah, so I have one question from, I think it was Kyle, who was asking about 2008, and you had mentioned that you were underwater with your mortgage or with your house. So do you want to talk a little bit about, what your mindset was? Because at that point you had already started investing, you were educating yourself, you were riding through the first, I'm guessing, recession that you had experienced while you were at, into personal finance. So can you talk us through, how you fared during that time, and what did it feel like to go through your first recession?
Yeah, not fun. I think so. I had just inherited some money and purchased a house. And I think between all of that, my net worth was like 300,000-ish. And then all of a sudden, my portfolio dropped in half, and my house was 100,000 in underwater. So that 300,000 was all of a sudden 60,000 as a net worth. And that was in this period of a year and a half. And yeah, I think at the time I didn't really know how bad that was. And that was almost like a plus. Even though it was underwater, I still had my job. We were still able to pay our mortgage. We were still able to continue making payments. That was never an issue, especially since I had money saved up from the windfall. And so we never really thought hey, we should short sale this or anything like that. Part of it was because we liked the house. But I think if we didn't, we probably would have really looked into short selling it. And I think if I was personally managing my money at that time, I might have been more likely to sell it. But part of the fact that I was working with a financial advisor, I stayed in the market during those low times. And so I was able to take advantage of the market when it rose. And yeah, that's one thing that I am appreciative about having that assistance from the financial advisor for.
So potentially that's worth the front load.
It might have saved me money. I mean, it cost a lot, but who knows? It might have paid off in the end.
Mm-hmm. And then eventually, did you roll your money out of the financial advisor services and you manage it yourself now?
Yeah, I started with just creating a Roth IRA at Vanguard, and I invested using that for a year. And once I felt like I knew what I was doing there, I rolled over a 401k from a past job to an IRA on Vanguard, and I managed those two accounts for a year. And after that, I was putting all of the new after-tax money that I was saving into a Vanguard account. And so after 3 years of building on knowledge and learning Vanguard, I was okay, I'm going to transfer all of my money from the financial advisor and leave them all together. So yeah, it wasn't overnight. It took a couple years to kind of get to that point where I felt comfortable doing it.
Got it. Great. And I guess I have one more last question, and I'll turn it over to Justin. Did living through that 2008 recession help you with dealing with the uncertainties in this pandemic and the subsequent market drop that happened earlier this year?
Yeah, it definitely has. I think it's kind of the mindset of is the market going to recover, or is it just never going to recover? And I think if you're in the mindset of it's never going to recover, then you're going to be much more likely to withdraw everything today or try to time the market. But if you have confidence that it's going to eventually come back, it's a lot easier to keep your money in the market. And I think to this date, the two moments I have felt the closest to the market's never going to recover were in 2008 when the entire financial institution was crumbling, and probably in March when we were like, is this pandemic going to be the stand part 2? So it's like a part of it is also listening to less news so that you're less likely to be like overwhelmed with the bad parts. And I'm still working on that one, but I know it impacts my decisions for sure.
Awesome. Cool, Adam. So we're going to start to shut this down. But I wanted to kind of ask you a 3-part question, really challenge you right at the end. Any advice or coaching for somebody who's, here's the first part, on the beginning of their FI journey. The second part, someone who's in the middle of their FI journey. And third part, someone who's nearing the end.
Yeah. Let's see. So when getting started on the FIRE set journey, I would learn how to invest on your own using diversified low fee index fund investing in like a Roth IRA or a 401k, something that's very forgiving when you make mistakes. For tax purposes, you don't have to worry. There's not as much surface area that you have to learn to take advantage of those. So that would be kind of one of those first steps. Probably second would be like really understanding like the sequence of accounts and how you invest in those. When I say sequence of accounts, it's like where your money flows through. Like, first is like having 3 to 6 months savings. And then after that is like a 401k match at your company. And after that might be like a Roth. And after that might be like maximizing your 401k. And after that might be like an HSA or a brokerage investing. And really understanding like the whole sequence of accounts and which one your next dollar that you make is going to go into. And then probably third would be understanding the tax side of it. Once you are getting closer to retirement, where you're going to have to start selling funds, and this is probably starts maybe 5 years before you actually pull the trigger on RE, but understanding when you actually start taking money out, how are taxes going to play into those decisions. I see a lot of people who write articles where it's like, I have $1 million saved up and I'm going to spend $40,000 a year, but that $1 million is all in a 401k. Like that, the math's not going to work out on that, because when you take the money out of your 401k, you're going to be paying a lot of taxes. So the amount you need to retire is going to be dependent on what your tax rate is going to be when you take that money out. And so understanding that probably starts a couple of years before you retire, and it kind of goes on probably from then until the rest of your life.
Awesome. Really good job there. 3-part question, crushing it. Awesome. So Adam, first part, best place to find you online and connect with you. And then your kind of any closing thoughts that you have, and then I will do some kind of larger closing thoughts around the meeting and everything. So best place to find you and closing thoughts and words for people.
Yeah, thanks everyone. You can find me on Minify screen I kept sharing. I blog somewhere between once every 3 months and 3 times a month, depending on what I'm doing. Lately, I've been building a lot of tools using Vue.js and D3 just for fun. If you want to check it out, I have a free course on getting started investing. It's probably that first part from the FIRE series. And I have a boot camp, which is a 10-course series. That's it's a pay what you want model. So anyone who wants to join, you just join and pay what you want.
Can you drop those links in the chat right now?
Yeah. There we go. Just minify.com/bootcamp. And yeah, you can follow me on Twitter. On the Minify side, I have a Twitter account, Minify blog, and then I have a personal Twitter handle where I mostly just talk about development, software development, and whatever else comes up.
How about Instagram and LinkedIn?
I'm trying to leave Facebook. That's going to be one of my goals for 2021 is just to get off Facebook 100%. LinkedIn, I'm probably on there as Adam Fortuna from when I had a job, but I don't check it.
Okay.
So mostly those two Twitter accounts are where I'm most
So
active.
no Facebook and no Instagram.
Right.
Gotcha. Cool. Any last thoughts or words you want to leave everyone with? Any holiday or inspirational words? Okay, if you don't, just.
Yeah, I'd say yeah, working towards FIRE sometimes seems like, at least for me, like setting a goal and just working towards it. But make sure you're building the life you want now and the lifestyle you want now, because if you're working towards it, that's what's going to be the rest of your life. So make sure it's what you want to have the rest of your life be.
That's amazing advice to end on. So yes, everybody, create the life that you want forever now instead of waiting till you get to FI. So that's really wonderful, beautiful advice. Adam, from both me and Anna and really everyone here, thank you so much for giving us 2 hours of your energy, your time, your mental bandwidth, your emotional and spiritual bandwidth. We really deeply appreciate you. This is a wonderful Christmas gift. I'm sure all of us, if you're open to it, would love to have you back on in 3 to 6 months if you're down. So I'm going to pause and see if you're down.
I'm down for it sometime, assuming people want me back in 3 months.
Yeah, we'll say 3 to 12 months.
There you go.
Cool. Awesome. And then Adam, thank you again. Really appreciate you. Everyone, the reason Anna and I, created this meetup in the beginning was to create real friends that are FI people in real life, not just like random blogs that we follow, even though people like Adam and the other bloggers are incredible resources, inspirational, but to actually create real friendships and connections with people who are on the FI path, because it can be lonely if we don't, all of our coworkers or people in our life don't follow FI or understand or are into it. So if there is anyone in this group that you want to connect with, or you would be open to connecting with people, feel free to drop your contact information into the chat, whether that's email, LinkedIn, Instagram, whatever your preferred phone number, whatever you feel comfortable sharing, and then connect. We'll wait a few minutes if people want to directly message people and be like, hey, I'm so-and-so, you're from the same town as me, I saw, or whatever. So connect with people. I'll put my information in there, and we will definitely do another one of these next month. So stay tuned. We may or may not have a guest, and myself, I'll put this video up on something, either YouTube or the Facebook group or something, probably YouTube, so everyone can get to it. And then Anna will actually, Anna's going to collect the entire chat and it's going to go into the Facebook group. So if there's any resources here, the links Adam shared, the links other people shared, that'll all be available in the Facebook group. And yeah, Anna, am I missing anything?
I remove people's personal information. So
Oh yeah.
before I post it on Facebook. So like if you're putting your phone number and stuff, like I'm not going to share that. Unless you want me to, you can say, hey, you can keep this here if you want. The main thing I want to do is thank you, Adam, for the gift of your time today and joining us as our guest speaker. You've been so generous in sharing your knowledge, wisdom, and all of the resources that, you know, clearly took hours, hundreds of hours to build, to share with the community. So thank you very much for your generosity.
Yeah. Awesome. Cool.
Thanks for having me.
Well, on that note, everybody, good work making it through probably the most challenging year maybe any of us have ever been through in our life. Maybe not for all of us, but definitely many of us have gone through challenges. So great work. We did it. We're at the end of 2020. We'll see what 2021 brings, but you got this community. So definitely stay connected. Come back to our next meeting for learning, inspiration, and harnessing the hive mind. Have an incredible holiday, whatever you celebrate. And let's all ring in 2021 and have an incredible new year. So thanks, everybody. And Anna and I will kind of stay on for a minute, make sure everyone gets everything that they want out of the chat in terms of connecting with people. But yeah, everyone, you're welcome to sign off. Anna and I will eventually start kicking people off, and then we'll officially end this. So again, Adam, thank you so much. Everybody, thank you for sharing your time and energy with us. Merry Christmas, everything else you celebrate, and Happy New Year.
Happy New Year.
Awesome. Well, thanks, Anna. Really appreciate you. Actually, I'm going to stop the recording now.